There was no shortage of market moving events in the fourth quarter of 2024. I'm Ron Sneller, registered financial consultant and investment advisor representative. Thank you for joining me as we do our fourth quarter 2024 recap and our 2025 market outlook. Let's get right into it. The stock market opened the quarter with a slow start in October, but the outcome of the presidential election triggered a broad rally in November. Unfortunately, that rally faded as the year ended, although as the year did end, the S&P 500 was trading only a few percentage points below its all-time high. The credit market was equally active in quarter four, with the Federal Reserve cutting rates by another 0.5%. However, the major development was the changing 2025 outlook. The Fed and the market, they both now expect fewer rate cuts in 2025 compared to where they were expecting just a few months previously. Now, this resulted in a sharp rise in Treasury yields in quarter four. So in today's video, we're going to recap the fourth quarter, looking back on the 2024 stock market rally, provide an update on the economy and the Fed's rate cutting cycle, and look ahead to 2025. The past 2 years have been remarkable for investors, with the S&P 500 delivering strong returns of over 20% in back-to-back years. I've got 3 charts that I want to share with you on this to take a closer look at the stock market's rally in 2024, a year in which the S&P 500 set more than 55 new all-time highs. The first chart, which graphs the S&P 500's return for each calendar year since 1980, shows the index posted gains of over 20% in 2023 and in 2024. This marked the first time that we had back-to-back gains of over 20% since the 4-year stretch from 1995 to 1998. And like the late 1990s, large cap technology stocks played a major role in the S&P 500's gains. The second chart here shows the 2024 price returns of 7 different ETFs, each reflecting exposure to companies of different market cap sizes. This chart reveals a significant gap between the returns of the large cap versus small cap stocks in 2024. The top bar tracks the Magnificent Seven, a group of stocks that includes Microsoft, Apple, Alphabet, Meta, Amazon, Nvidia, and Tesla. These 7 companies, which now account for more than 33% of the S&P 500, returned over 60%. When we look at the second bar there, if we were to expand that group from the Mag 7 and include the 50 largest S&P 500 stocks, the return falls to 32%. Still very impressive, but about half the return of the Magnificent Seven. Let's move down a notch. Let's broaden the group further to include all S&P 500 companies. This will reduce our return to approximately 23%. That's the broad S&P 500, right? And if we look down to the fourth bar, if we were to weigh each company equally rather than by market capitalization, this would lower the return to just 11%. So the key takeaway here is that the largest companies contributed a significant portion of the S&P 500's returns in 2024. Smaller companies delivered solid returns around 10 to 12%, but they underperformed on a relative basis. Now, more precisely, let's take a look at those 3 bottom bars now. An index of mid-cap stocks returned 12%, while small cap and micro cap stocks returned 10% and 12% respectively. The concentrated stock market rally, which was driven by the outperformance of the largest companies, led to an unusual outcome. This third chart shows the percentage of S&P 500 companies that outperformed the index during each calendar year. For the second consecutive year, fewer than 30% of the S&P 500 companies beat the index. This is significantly below the average of 49% since the year 2000. And once again, just highlights the dominance of the largest companies in 2024. The U.S. economy has consistently defied expectations of a slowdown since the Fed started raising interest rates in March of 2022. Economists and market participants alike initially expected growth to slow as the Fed raised interest rates. However, it has been now nearly 3 years since the Fed's first rate hike, and the economy continues to grow at an above-trend rate. While higher rates have slowed housing demand and weighed on business investment, the U.S. economy has managed to defy expectations with solid GDP growth. This chart here shows the U.S. economy grew at a 3.1% annualized pace in the third quarter of 2024, marking the third quarter in the past 4 with growth above 3%. Now, these next two charts I'm going to show you, they're going to show the key drivers of economic growth since early 2022. This chart that you see on your screen right now tracks the contribution of personal consumption expenditures, i.e., consumer spending. It's going to track that to U.S. GDP growth. Despite high interest rates, consumer spending has remained a steady driver of growth in recent quarters. Now, multiple factors have increased household net worth and bolstered consumers' financial strength. I mean, we're talking about record high stock prices, rising home values, and solid wage growth. Additionally, many borrowers locked in low interest rates during the pandemic, which has made the U.S. economy less sensitive to rising interest rates during this cycle. Now, this third chart here shows the surge in manufacturing-related construction in recent years. For a long time, manufacturing construction was relatively modest, as most activity was outsourced to China, Mexico, and elsewhere. However, that changed in late 2021, around the time where Congress passed trillions in new spending on infrastructure, green energy, and subsidies to incentivize U.S. manufacturing. These spending bills have been extremely supportive of the U.S. economy and created a boom in the manufacturing of semiconductors, electric vehicles, batteries, and solar panels. The result is a surge in manufacturing-related construction, the largest on record, in fact, as companies build new warehouses, industrial facilities, and semiconductor plants. The artificial intelligence industry's emergence has provided another catalyst as companies like we just talked about, Microsoft, Amazon, and Meta, spend billions on data centers, information processing equipment like semiconductors, and energy production to meet growing power demand. Economic growth, it is forecast to slow, but remain solid next year, driven by the Trump administration's pro-growth policies. The new administration's policy agenda focuses on extending the 2017 tax cuts, reducing regulations across industries, and boosting domestic manufacturing through targeted incentives. These measures have the potential to stimulate capital expenditures, expand manufacturing capacity, and attract foreign investment to the United States. Now, the Fed continued its rate cutting cycle in quarter four, lowering interest rates by a quarter point at both the November and December meetings for a total of 0.5% interest cut. The 2 quarter point rate cuts were well telegraphed by the Fed, and they were widely expected. But the big development in quarter four was the changing outlook for 2025. Despite the 2 rate cuts, Fed Chair Jerome Powell and the other Fed presidents indicated they are not in a hurry to cut rates further. This change in tone followed the U.S. economy's recent strength, which has caused the Fed to re-examine the need for additional rate cuts. Recent economic strength has also led the market to reevaluate its rate cut forecast. This dynamic can be seen right here in this chart showing the bond market, where longer maturity Treasury yields have risen sharply since the first rate cut in September. This graph shows the 10-year Treasury yield against the federal funds rate, which is the interest rate the Fed adjusts to set monetary policy. Since the first rate cut in September, the federal funds rate has decreased by 1%. Over the same period, however, the 10-year Treasury yield has had the opposite reaction, rising by nearly 1%. Now, this has confused many investors, so it's important to note that while the Fed controls shorter maturity interest rates, the market has more control over longer maturity interest rates. Now, what caused Treasury yields to rise as the Fed cut interest rates? Well, 2 key data points contributed to the Fed's decision to start cutting rates in September: falling inflation and rising unemployment. Inflation declined from 3.3% in July of 2023 to 2.6% in August of 2024, while unemployment rose from 3.5% to a high of 4.3%. The 2 trends caused the Fed to shift its focus from lowering inflation to instead supporting the labor market. However, since the Fed started cutting, the trends have reversed. Inflation progress had stalled since September, and unemployment has ticked back down to 4.2%. So heading into 2025, the Fed and the market have similar rate cut expectations, approximately 0.5% in rate cuts for the entire year. Now, the question is whether they're placing too much emphasis on recent trends and are underestimating the need for rate cuts. As both the Fed and the market saw in 2024, forecasting Fed policy is difficult, especially in this cycle. Now, the stock market ended quarter four higher, but the path included periods of volatility. In October, the S&P 500 ended its 5-month winning streak, with most of the equity market finishing slightly lower. The sluggishness occurred as Treasury yields rose after the Fed's first rate cut in September, suggesting the sharp rise in yields may have played a role in October's market action. However, stocks rebounded in subsequent months. In November, the quick and decisive election outcome became a tailwind for stocks. Investor enthusiasm fueled the post-election rally, with stocks trading higher in anticipation of tax cuts, deregulation, and U.S.-focused trade policies aimed at benefiting U.S. companies. Small caps led the way during this broad market rally, with the Russell 2000 rising 11% in November to set a new record high. Bank stocks were another popular post-election trade as investors priced in expectations for financial deregulation and strong economic growth. Industrial stocks saw broad-based strength in anticipation of the Trump administration's pro-growth policies and protectionist policies, which could spark an industrial renaissance in the U.S. At the end of November, the S&P 500's year-to-date return passed 26%, putting the index on track for gains in consecutive years of more than 20%. But in December, the market's excitement cooled, with the S&P 500 trading sideways and ultimately ending the month lower. Beneath the surface, a familiar trend from earlier in the year impacted returns, with smaller companies underperforming larger ones by a wide margin. The Russell 2000 index was hit the hardest in December, falling 8.4% and giving back most of its post-election gains. Value stocks also traded lower in December, with the Russell 1000 Value Index declining by 6.8%. In contrast, with most of the market falling in December, the Magnificent Seven stocks that we discussed earlier actually gained more than 5%. Now, shifting focus to global markets, international stocks underperformed U.S. stocks in quarter four. The MSCI Emerging Market Index returned a negative 7.2%, while the MSCI EAFE index of developed market stocks returned a negative 8.3%. Both of the major international equity indices underperformed the S&P 500 by nearly 10% in the fourth quarter due to currency headwinds, i.e. a stronger U.S. dollar, and the outperformance of the U.S. mega caps. Looking ahead to 2025 for international markets, the potential tariffs under President Trump is creating significant uncertainty across several global regions. The sharp rise in Treasury yields weighed on bond returns in quarter four. The biggest differentiator within the bond market was duration, or the sensitivity of a bond's price to interest rate movements. High-yield corporate bonds produce a total return of negative 0.1% due to their lower sensitivity to rising interest rates and higher absolute yields. In contrast, investment-grade bonds returned a negative 4% as rising yields had a much bigger impact on their longer maturities. Excluding interest received and only looking at price returns, an index of investment-grade corporate bonds posted its biggest quarterly loss since quarter three of 2022. For the year end of 2024, full-year credit returns highlight the key themes that shape the bond markets throughout 2024. Higher quality bonds like U.S. Treasuries, corporate investment grade, and mortgage-backed securities underperformed as the market debated and ultimately lowered its rate cut expectations. In contrast, lower quality bonds outperformed as economic growth and corporate fundamentals remained solid. Corporate credit spreads, which measure the difference in yield between two bonds with a similar maturity but different credit quality, steadily tightened throughout the year. This provided a boost to lower quality bonds in 2024, but has left credit spreads near their lowest level in decades. For context, the U.S. high-yield corporate credit spread is near its lowest level since 2007, which means investors are receiving less yield in return for taking on that credit risk. The S&P 500 steady climb in 2024 reflects the market's growing confidence. Investors are optimistic about the artificial intelligence industry's growth potential. The U.S. economy outperformed expectations, growing at an above-trend rate in 3 of the past 4 quarters, despite high interest rates. The stock market rally intensified after the election in November as investors focused on the incoming administration's policy agenda. Expectations are for tax cuts, deregulation, and energy production. Those are all fueling hopes of stronger economic growth. The bond market echoes the equity market's confidence, and corporate high-yield credit spreads are near their lowest levels in over 15 years. However, the equity market rally has made broad market indices like the S&P 500 more concentrated and more expensive. The question on many minds is whether this momentum can continue in 2025. The S&P 500 currently trades at nearly 22 times its next 12-month earnings estimate, a level not seen outside of periods like the late 1990s tech boom and the recent post-COVID recovery, where interest rates were near zero during that. Investors have shown a willingness to pay higher multiples, but with valuations now at extremes, earnings growth will likely play an important role in determining the stock market's path in 2025. Figure 4 that you see on your screen, it tracks the current bull market, which started in October 2022 and is now in its third year. The current bull market has performed in line with historical norms, but the chart shows that returns often moderate as bull markets mature. This suggests that the market's focus could shift to fundamentals and earnings as the next catalyst to push markets higher. 2025 is shaping up to be a year where companies will need to deliver on investors' expectations to justify their high valuations. As a standard disclaimer, this video is for educational purposes only and is not intended to be financial or investment advice. If you would like professional assistance with the management of your portfolio or your retirement income planning during these trying times, you can connect with us through our website at snellerfinancial.com or through one of our many social media channels. Once again, I'm Ron Sneller, registered financial consultant and investment advisor representative. This has been our fourth quarter 2024 recap and our first quarter 2025 market outlook. Thanks for tuning in, and we'll see you next time.